My name is Jim Narron. I'm the first Vice President and Chief Operating Officer at the Federal Reserve Bank of Philadelphia. So on behalf of everyone here at the bank, I'm delighted to welcome you back to day two of this fourth annual conference. So before we get started, I just wanted to do a little bit of housekeeping. So as I mentioned, it's our fourth annual conference. Something new this year, it's our first time doing this virtually. So we really appreciate everybody hanging in as we all explore this new technology. So that's something new this year. What's not new is the standard Fed disclaimer. So the remarks that I give today are mine and mine alone. They don't necessarily represent the views of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. And so we've got that out of the way. So I'm just really thrilled that we've got a stellar group of speakers today. They're going to talk about the relationship between big tech and central banks and on the development of central bank digital currencies. But before we turn it over to our panelists, I just a couple of minutes, a few of the main considerations and themes that I suspect we're going to hear during our discussions this afternoon. And my remarks are going to be brief. Now, I've worked for 4 different reserve banks, plus the Board of Governors, Treasury, and in the private sector, and across a variety of banking functions. And what I can tell you from my own personal experience is that the Fed and the private sector have a long, very fruitful, cooperative relationship. Now, much of that's based on sharing of information. Now, we can learn from the private sector, in particular big tech, what's happening in the economy in real time. That's really important for us. That strengthens our research capabilities and really bolsters our ability to formulate policy that best addresses current economic conditions. Now, epidemiologists have long used search analytics to pinpoint disease outbreaks. So if people in a certain part of the country are furiously Googling flu remedies, that's a pretty good bet that there's an outbreak of influenza in that area. Now, likewise, search analytics can inform us of localized economic events. Let's say a spike in search for unemployment claims in a certain part of the country or among a certain demographic group can tell us something important about what's happening in local economic conditions long before the official data would ever tell us so. Now, one of our panelists is going to be providing some pre-recorded remarks today. Varian, Chief Economist at Google, certainly is going to have something to say about this. But this kind of relationship that I'm talking about, this relationship between big tech and the Fed, really predates this kind of hyper-sophisticated activity that I'm describing. So back around the turn of the millennium, back when Google's employee headcount probably numbered in the hundreds, not the hundreds of thousands, I was working at the New York Fed running their cash operation when a tractor-trailer shipment full of nickels, our little 5-cent piece, was robbed. Yes, nickels. So imagine the disappointment with the thieves when they opened up the back of that trailer and found it was full of nickels. Now, the Fed's had this long-standing relationship with a company called Coinstar. That's a company here in the U.S. that owns these little green kiosks that people dump their coins in when they find them between the couch cushions. So we asked Coinstar, and they have great data, to look out for any deposits of nickels. The nickels come in $2,000 bags, so they can see these increments coming in. So we asked them to look out for any patterns that might be emerging. They did. They found just such a pattern in the southeast of the U.S. where this robbery took place, which eventually led law enforcement to the nickel robbing bandits. So if you think about this, this is really an early example of big data in action. So big tech can help the Fed gather information, formulate policy, even fight crime. And as a general rule, there's no doubt that increased access to data is a boon for policymakers like us. But the relationship also raises important concerns about privacy. Big tech hoovers up extraordinary amounts of data and information on all of us each day. So tech firms and the Fed are going to need to work to strike that right balance between protecting people's privacy and using information in a way that serves the economy and our society. Now, similar concerns are going to lurk with a central bank digital currency, and that's the topic of today's second panel. So first, a quick note about how central bank digital currencies function. So much of my time in the Fed has been spent running our cash businesses. Cash continues to be an important part of the financial system. Despite its predicted demise, it's still here. Cash demand has remained robust here in the U.S., even during the pandemic. But central banks and the Fed really issue two types of money, both the physical currency that I'm talking about and reserves. So think of reserves as the electronic unit of account that banks hold with a central bank. So a new central bank digital currency would combine features of these two existing types of money. So like cash, a well-designed central bank digital currency would circulate widely in the economy. It'd have universal, either low-cost or free access for households and businesses alike. And like reserves, a central bank digital currency would exist in electronic form, really making it easier than physical currency to store or to use in transactions across larger distances. Now, there are obviously potential drawbacks as well, the potential loss of privacy and anonymity. Now, we all know somebody who prefers to use cash because he or she doesn't like their spending being tracked, even if it's as innocent as that daily latte at the coffee shop. And what if someone's tracking my spending patterns to make credit decisions on me? These are all issues for serious consideration, and at some point, potentially regulation and possibly legislation. So as with big tech, we'll need to strike that right balance that maintains the appropriate privacy protections while also promoting efficiency and the benefits that we get. Now, of course, the Federal Reserve hasn't been a first mover in digital currency development for some pretty obvious reasons, but it also appears that central bank digital currencies are coming one way or another, which is why I'm delighted that we're hosting the conference today. So thanks again to everyone for joining us. And now let me turn things over to our first panel of the day, which is going to look at big tech and central bank collaboration. So we're extremely fortunate today to be joined by Per Nymand-Andersen. He's an advisor to senior management at the European Central Bank. Varian is going to be providing some prepared remarks via video. He's senior economist at Google. And moderating our discussion today is going to be Csabay of FNA. So thanks everybody for joining us, and please enjoy the program this afternoon.
Thank you very much, James, for the kind introduction. It's a real honor to be here, and many congratulations to Giulia Giactiani and her colleagues from the Federal Reserve Bank of Philadelphia for organizing an extremely interesting and extremely insightful conference. Ladies and gentlemen, good day. My name is Csabay. I'm the head of Subtech at FNA, and it will be my pleasure to guide you through this session. We are going to cover, I think, a very interesting topic, as we are going to talk about the case study of a partnership between a big tech firm and a central bank, and we will also discuss some of the key opportunities and implications for the mapping and monitoring of the financial system and of the economy. I'm very pleased to say that we are joined by two seasoned practitioners who are very well equipped to guide us through this kind of collaboration. Our first speaker is Per Nymand-Andersen, advisor to senior management at the European Central Bank with over 20 years of central banking experience. Per is also an author of several publications, including a soon-to-be-published book on data science in finance and economics. Our second speaker is Varian, chief economist at Google, and of course one of the key authorities in the fields of data science and economics. Before we start, ladies and gentlemen, I would like to encourage you to submit your questions through Slido, and we will do our best to cover as many of them as possible. But now, without further ado, let us start with our discussion, and I would like to invite to our virtual stage our first speaker, Nymand-Andersen from the European Central Bank. Per, welcome, and many thanks for joining us at this conference.
Thank you very much, Adam, and thank you for this kind introduction. I would also like to thank Julapa Yaktiani and the Federal Reserve Bank of Philadelphia for this kind invitation, including also the other members of the organization committee, Christopher Ferney, Richard Henning, Aaron Klein, Patricia Moser, and Ragnar Vandera Rao for your kind invitation to speak about the use of non-standard data and partnership. And I have my three messages I would like to convey to you. First is that data never sleeps, so there are so many alternative sources that are being used now. And then I will make a little a demonstration of how we have used the Google data in order to now cast car sales, and then the way ahead. And as a central banker, I would like to say that the opinion that I'm expressing in these presentations are not necessarily those of the European Central Bank or those of any of the central banks in the European system. So they're all on my own personal account. So we have a beautiful time. I mean, the amount of fintech platforms that exist and the digital transformation in finance and economics provides us with a huge paradigm of records that are all digitalized. And these can come from the digital trading. So, for instance, the ECB and we are now producing daily yield curves of the AAA and Euro area bonds, and they are coming from EuroMTS in Paris, the electronic trading platform in Paris, and we are taking this data on a daily basis with the price information, and then we are releasing the Euro area daily yield curves on the ECB website every day at 12 o'clock. Of course, then we have their own clearing and settlement systems, a lot of interest of consumer and credit card use, mobile payment, scanning data, and what we will talk about today is the social media and the use of Google data. Of course, there are many financial platforms of Alibaba and the various Alipay and CreditPay that exist. Crowdfunding, where, of course, lenders and financial investors are meeting in order to allocate and distribute funds. And then, of course, we have the big blockchain, digital ledger technology, crypto assets, digital assets, smart contracts, tokenizations of various assets, and token trading that are then also leads over to supply chain management and the ecosystem. So there is enormous rich pool of digital data that can be used. And this, of course, data never sleeps, so this is just an illustration of how much digital data that is generated every single minute of the day. And of course, these non-standard high-frequency data has now become more important. They're, of course, triggered by the COVID and the pandemic trigger to have more timely and daily data. In particular, to look at consumer spendings, which you can use credit cards and debit cards. Also, restaurant bookings can be an indicator, air travel. So they are different alternative sources. And what I would like to demonstrate today is the partnership that we have with Google, using the Google search terms of the exchange of knowledge that we have. And from the central banking point of view, we are a data-driven organization, at least we believe so. And we have a lot of experience in handling micro-level data. So we have a lot of micro data from all bank loans to other banks, to the money market loans, and we have securities issues and trades, and we have bank loans to the corporate sector. So we have a lot of micro. So we obtain millions of micro data every month, and we are able to manage and systemize this data. So we have something that we can offer. Then, of course, we have the analytical capacity and skills as central banks. We are very much analytical driven, and we are also familiar with the data science techniques and tools. And not last to least, central banks, we are independent, and therefore we provide objectivity in the advices that we provide. And then Google can offer to us, which they do, it's all the Google data, all the Google search data for 14 countries we obtain free. They have also made a taxonomy of all the search terms, so they're all categorized into different baskets. And we are then sharing the insights of methodology and how we're using the data and such. And we are automatizing machine-to-machine downloading of the data that we obtain from Google. So this is what I would like to demonstrate. And one of them is, of course, that for central banking purposes, we have an interest in looking at these alternative sources, not only maybe triggered by the COVID, has certainly raised the agenda item of it, is in order to get supplementary insights, to get near real-time snapshot of the economical situation, can help us with detecting early warning signs that may have, and of course to help us detect trends and turning points. And then, of course, the feedback loop from when we do policy measures, what are the reactions of the market? And then, of course, these supplementary data could provide new insight that maybe we can adjust and maybe even develop new theories. So better predictions stimulate the debate. We all know we need to adjust our model-based theories and maybe include some more cognitive processes in decision-making, and it's not so linear. More timely and frequent information. And this relates not only to central banking monetary policy arm, but also to banking supervision as well. So what we have done with the Google data, and this is the example, we have then a category of the Google data that we have used, and we have taken all the search terms relating to cars and put them into a euro area indicator called auto and vehicles. And then we have created a single indicator called then the Google data. And the Google data we are then compared with the official car registrations by the car industry. So this is the first thing you do. Of course, you generate your indicator, you simply develop it, and then you simply plot it together with the official data from the car registration. And this is how it looks like. So the red line is the Google data sets, the official one, and is the blue. And then we simply see and look, and then we start with a little bit econometrics and look at what are the dynamics of these two series. So the first thing we see is that there is a certain co-movement of the two series. In fact, there is a two-way causal relationship, so they both seem to, in this example, to influence each other. And there seems to be a 5-lag length of the Google data vis-a-vis the car registration. So that seems like that every time we have here the Google data, it seems like that 5 years down the road, there is a similar type of pattern. So this is just by making some preliminary econometrics on the data to get a feeling of your data. And then we are then trying to do some nowcasting. And here I have 7 different autoregressive models that we have used. I will not go into the details, but they're relatively simple. We have a baseline model that is simply taking the car sales and then using the seasonal data from 12 months beforehand, and then we see how good it is as a predictor. And then we include it with the Google data. And then we try with other types of indicators. We use the CPI, so the Harmonized Index of Consumer Products. We use industrial indicators and the total income of households, plus the Google data. So how do they then perform? And this is the results of all the tests that we have done. So we have the baseline model on one side, and then we have all the different models that we have tested, baseline with the Google, then inflation rate with the Google, and then confidence indicator with the Googles, income with the Googles, and so on. And then we have just tested all indicators. And then across, we have taken criteria as of relating to the error terms that we have, which are the root mean square errors, the mean absolute error, and the mean absolute percentage error, which is the forecasting error. And then we simply take an average of how much more or less the improvements compared to the base model have been. So there is 5 takeaways from this little exercise we've done. One thing is that just using the baseline model, as we have seen, seems to be quite well. It performs quite well just using the baseline model. The second thing we see that every time we add the Google data, the improvement seems to improve. So including the Google data in our forecasting improves the error term, so it reduces the errors. The third is using the model with income and Google seems to reduce the error terms by 30, so that is the highest, so the best performing model. And of course, if we then take all the indicators together, there's a slight increase. And then with the Google data including, we simply reduce the error term significantly. The fifth is that when we use the Diebold and Mario test, so that is to say that if we compare the forecasting accuracy using this data set, can we statistically say that they're significantly better predictors using the Google data than not using the Google data? And for this, everything that is highlighted in red indicates that it's statistically significantly better predictors than not using the Google data. And that seems to be the case for every single time we have used the Google data, that they all statistically significantly perform better than the baseline model. And the sixth takeaway from this exercise is that we do exactly the same test, so exactly the same Diebold and Mario test pairwise. So I'm looking just at the model inflation rate with Google, so pairwise. And there I also see that including the Google data in this model compared to the model without the Google data, the model also performs statistically better than without the Google data. And then there is a little outlier. One could say that for the household savings and the household saving with the Google data, I need to go up to the 20% acceptance significance level before I can then reject the H0 hypothesis that the data sets or the data models are the same. So these were a little taster of the data set we have with Google. Here we can then see the results of the Google baseline model and then the best model, so the model that performed the best. So that is the one in red. And then the base model is yellow and the official data is the one in blue. So having this experience, and maybe of course also other experience, I just wanted to make one little note that I meet all the time, and I will take the time here to simply say that just because we have all the Google search term data, or just because you have all the data from a certain fintech, does not necessarily mean that we have to convey what is sample bias and representativeness. And that seems to be a misperception that is very often read in also research books, research articles in different science, that we simply don't look and engage ourselves in the data. So, for instance, the Google data, it's a recording, right? So it's people's search, but there are other search machines. Right, so if we're just using the Google search data, and we also have to see who else are using other types of search engines. So they may not be fully representative of all the search terms, though of course they seem to have a certain monopoly or a large share of the search engine. Though, of course, it's not only households that searches, right? So there's also corporate that uses. So if you're looking at household expenditure or households expenditure in this case for the car sales, there are also a lot of searches that doesn't relate to households. And then, of course, we still have certain areas where the internet connections are not very good, and not all types of people are using the internet, and maybe there's an age and other types of criteria of people that we don't get. And then, of course, the second issue is that we are not measuring people, right? So it's a unit measure. It's a search. It's a search term. That means that one person can make 20 or 30 searches. So therefore, it's not about people, but it's about searches. And then, of course, using search engines, it's event-driven, right? So there can be many searches that are happening in a certain period of time. We have, for instance, the car admission scandal, and then everyone is searching if their car is impacted by the diesel or if they have this motor or this car. So they're not driven necessarily by the people would like to buy a car, but you have to then, of course, remove the data that will, in this case, be considered as outlier. So my three takeaways to you from this presentation is that we have to experiment with these alternative sources, and these experiments they do not bring short-term results, but we will in the long term see the benefits of these. And they are valuable sources both for economic and financial activities. And we need to think about digital data strategy and how to make data more borderless. We have in the EU European data strategy. We have to find out not only about the data, but it's also about the metadata and how to share data cross-border, while of course preserving the confidentiality of data. And it's about moving from experimenting with the data to have it part of a toolkit that we can then use it as part of giving advice. And certainly my encouragement is to leverage between the partnership between fintech and central banks, but also the academia as part of leading for excellence. So thank you very much.
Thank you very much, Per, for your very insightful and interesting presentation. I have a number of questions I would like to ask, but in the interest of time, I will leave them for later. And now, ladies and gentlemen, we are going to focus on the contribution of our second speaker, Varian. Varian was unfortunately not able to join us in person, but he kindly agreed to pre-record his remarks, and we are going to watch the pre-recording of his presentation as well as of the discussion and the Q&A now.
Thank you very much for inviting me to this meeting. I'm sorry I couldn't attend in real time, but I hope the video will be some consolation. So I want to talk today about Google tools for nowcasting. And let me start with a little example. We're going to look at data from Google Trends and Google Consumer Survey, and then we'll look at some analytics and tools that we've developed here that are available to you for your own analyses. And I start off with a question for everyone. Which day of the week are there the most searches for hangover? And how would you find out? Well, you go to Google Trends, type in the term hangover, and you see that actually they peak every Sunday. And what's that great big giant spike? That's actually New Year's Day. You can look at it geographically. So here's the incidence of queries for hangover across states in the U.S., and you can see the kinds of terms that people are entering in for this particular case: the hangover, cure hangover, hangover remedies, and so on. And here's a plot of the hangover series in some color here, red, I guess, and queries on vodka. So if you look at this, they're off just by one day. The vodka searches peak on Saturday and the hangovers on Sunday. This is a beautiful example of Granger causality if you're into time series. A little picture there. Searches for Civil War. Why do they have that particular shape? Well, it's seasonal. Turns out the peak here is about 3 days before your term paper is due. And the reason the series has been going down is we're measuring the searches for Civil War, those particular queries over time. And during this time period, the internet went from being mostly something that was used on campuses to something that's used everywhere. So it isn't a decline in absolute interest, it's a decline in relative interest in this particular example. There's another little picture of what searches for term paper look like. And this is a nice example looking at gifts for boyfriend in blue and gifts for girlfriend in red. And the little drop there is Christmas. So you see the activity among the men who are searching for a gift for a girlfriend explodes right before Christmas because they see they've got only a few days left to get a gift. Same thing, gift for husband, gift for wife, looks like this, and so on. So there's a lot of fun things you can do with Google Trends of looking at what kind of searches people are conducting, but there are also some serious things where you can get some insight into economic activity. So you can do time series forecasting. You can do cross-sectional prediction where we look across cities or across counties, so on, and you can do various kinds of forecasting or nowcasting that I'll describe in a few minutes. So forecasting, that's predicting the future. Nowcasting, that's predicting the present. And why would you want that? Well, as you all know, economic data is released periodically on a monthly or sometimes quarterly basis. Data revised as new information becomes available. And what nowcasting gives you is a way to look at what's happening right now in the short term. And that can be very useful because the data can be more timely. And certainly for cases involving central banks, that's something that's extremely attractive. So here's an example. This is initial claims for unemployment in black, and in red you see the unemployment rate, the headline rate, and you can see that the initial claims is something of a leading indicator for the unemployment rate. And when you look at people who do forecasting, one of the most important numbers to look at is in fact the initial claims for unemployment because it gives you a high frequency view of the economy. Now, what would you do? Oh, here, this is a picture of the relationship, the time series of initial claims in blue and the unemployment office, unemployment filing in red. And you can see the queries on unemployment filing, in fact, seem to be very highly correlated with the series for the initial claims. And that's pretty reasonable because if you became unemployed, the first thing you might do is go to Google and type in unemployment office, how do I apply for unemployment, what do I need to apply for unemployment, where's the office located, et cetera, et cetera. And those queries are, of course, expressions of intent. And the intent is to file for unemployment, which is what's going on with this particular time series. So one thing you could do is you could predict the initial claims for unemployment from Fred or whatever using lag values of initial claims and contemporaneous queries on unemployment filing. So you could first run a very simple seasonal autoregressive model. That's what I call the base. And then you could throw in to that the Google Trends data, the query data on unemployment filing. And it turns out the R-squared goes up, the AIC goes up. Definitely there's predictive power in adding that initial claims queries, that is the searches, to your model. So we discovered this, I don't know, 10 or 15 years ago, a long time ago, and we built some tools that help you carry out this exercise. So for the particular one is something called BSTS, which is Bayesian Structural Time Series, where we use a Kalman filter for modeling the timing component, the seasonality and the lag variables and the structure from the time series. And then we use a regression component, what's called a spike and slab regression, for looking at the role of the Google query from the trends data. So I'm not going to go into the econometric details. I just wanted to mention those two things because anybody who wants to follow up can look at the literature in this area. You can get it from SSRN or my website at Berkeley, wherever. So the idea there is you have a trend plus a seasonal plus a regression, and what you do is that's your model as an econometrician. The regression is where you put in the data from the Google Trends. The trend and seasonal are your usual time series modeling. So you can look at seasonally adjusted data or non-adjusted depending on what your preference is. This is a very packed slide on column forecasting. I'm not going to go into it in detail, but just point out that it's also known as state space modeling, and it's a very handy tool, particularly for this particular problem. Again, I'm going to skip this slide because it's too detailed for the amount of time I have. This is what the code looks like. You say, why is my data, this response variable, might be the initial claims, and then you say, add a local linear trend. So I'm going to put some smoothing in there. Add a seasonal. I'm going to put in a daily day of week effects, 7-day seasonal adjustment. I put that together, pull that together as my model, and then I click the button and off I go. Now the question is, does the Google data help explain those initial claims? And if you look at that picture up at the top, we're looking at what happens if you just estimate using time series, no trends variable, that's in black, and with the trends variable, it's in red, and you can see there's a definite reduction in the error rate, particularly around the onset of the Great Recession. And then you can go back to that model, that framework, and look at how much of that change was due to just trend, how much was due to seasonal, and how much was due to the regression. That is, how much was due to the trends variable. You can see the regression really explained a lot. The sum of those three series are the actual, the sum of those three series depicted as the actual, and you can see the regression is playing a big role. So that's very helpful in describing the actual outcome variable. And we can see which variables were important. So what you do here is you throw in variables you think might be important, and then it reports back to you on the probability that they are in the regression. So here, if you look at it, unemployment office is the query that's the most helpful in predicting these initial claims. Filing for unemployment, Idaho unemployment, then a couple sort of spurious regressors down there on Sirius Internet Radio. These are not, don't have a causal interpretation, of course. The Idaho is not particularly important either because there are queries issued for the unemployment offices in every state, and that one just happened to have the highest correlation. You can do the same thing with other data sets. This is new home sales in the U.S. You've got the 80-20 mortgage is the Google Trends variable we chose, and these are the non-seasonally adjusted housing numbers, again, that I pulled down from Fred. Here, the variables that are predictive are queries on appreciation rate, IRS 1031, Century 21, realtors, real estate purchases, and so on. So in fact, the real estate related queries are important in helping to forecast or nowcast the real estate activity. I'm going to zip through this pretty quickly. I just wanted to show how the model improves as you add these additional explanatory variables. So here we've got just the raw data and fitting a simple trend to it, no predictors at all. Here we add in the seasonal component, so you can see how that varies. Then we add in appreciation rate, the IRS 1031, the Century 21 realtors, real estate purchase, and you can see you've got a very, very good fit. Now this is in fact an overfit. You don't want to, it doesn't necessarily have predictive accuracy, but let's see if we can fix that a little bit through an 80-20 mortgage share. Do a 1 month ahead forecast. So I'm now predicting out of sample, not looking at the in sample prediction, and it does 23% better than a simple autoregressive model. Another thing you can do is you can use query categories. So instead of using specific words, you can use categories such as real estate agents, home insurance, et cetera, And there we have a picture in the top of looking at how your model improves when you add in those commercial queries, and you can see the raw series down below. There's a nice feature in BSTS where you can fit the model up until some point and then freeze the model and just go ahead and forecast out of sample using the same model. That's what we did in this top graph. So the model was estimated on the observations to the left of that vertical bar, and then the model was frozen. No more learning, no more estimation. It would just use the predicted model that was finalized, let's say, at that point. So that's an example, again, of out-of-sample prediction. It worked really pretty well. Here's the same thing for motor vehicle sales. Same idea. Here I use categories, so autos and vehicles, vehicle shopping. That comes with the trends data. Every query is categorized, and you can see the same general idea works there. Build the model, freeze the build at some point, forecast the next however long you want to go, and you can get a model that does nowcasting, and in this case, some forecasting as well. Let me give you a geo example. This is sort of an economics example. There was some nice work by Ed Glaser at Harvard and his colleagues on the happiest cities in the U.S. And the CDC has a behavioral risk factor surveillance system that asks people, how satisfied are you with your life? And you can look at the responses by city. So you might want to know what queries are predictive of happy and unhappy cities. So we ran a little geographic example. And here are the predictors. Gambling, that's a big negative predictor. And it's not casino gambling or anything glamorous. It's basically lotto. If there's a high frequency of queries on gambling in a given area, you could be pretty sure people aren't going to be very happy in that area. Manufacturing, insurance, etc. So the black lines, I should have explained this, so black lines are the negative predictors, and the white lines are the positive predictors. So there's your regressions for happy cities. Every time I give this talk, people say, well, which are the happiest cities in the U.S.? Here's the actual and predicted based on that model, and the happiest city is Charlottesville, and the most unhappy city is New York. Maybe you already knew that. It was a bit of a surprise to me. Another tool, I'm going to leave Google Trends for a moment, is Google Consumer Surveys. And I'm sure you've encountered something like this as you've looked around the web. There'll be a survey that says, please answer this question to proceed, something of that sort. There's a very short, very simple one-question survey. People answer that survey, and then they go on doing whatever they were doing. Well, those surveys are posted by Google, and they are a fantastic way to do a very quick survey of the population, lasting a couple days, getting a few thousand responses that can be very helpful in judging things like consumer confidence and other metrics of that sort. Anyone can do these queries. The cost is dramatically lower than conventional surveys. The results come back in just a few hours. If you don't believe somebody else's survey, you could replicate it, which is very rarely done in the survey world, but now it's possible. And you can look at things where you're designing a big survey and you want to look at sensitivity or questions around wording or framing for some specific components of that series. So here's a question from Pew, who asked, if you were asked to use one of these commonly used names for social classes, which would you belong in? And you see a response of that sort. 45% of the population says they're middle class, 21% lower middle class, and so on. We asked the same question, and we got phenomenal alignment with the Google Consumer Surveys and the Pew forecasts. So this is responses from Google and the responses from Pew. And if you go to the Pew website, they do an analysis of the Google Consumer Surveys with respect to its statistical merits, and it's been very, it does really quite well in terms of performance. Here's a question on assembled in America. I prefer to buy products that are assembled in America. Strongly agree, 32%, agree, 30%, and so on. But you also get all the geographic data from this, okay? That's the really nice thing, that you can look at it by geography. You can look at predictors of survey responses in regions in places where there are a lot of queries on Chevrolet, firearms and weapons, country music and trucks, people strongly believe in assembled in America. Probably not too surprising. And these are the top cities on the left, which are basically South Carolina, Virginia, North Carolina, and the ones on the bottom, which are basically all the West Coast, California and Seattle and so on. There's a picture of the places where people strongly believe in assembled in America. Again, probably aligns with what your expectations are, but here's a nice way to quantify it and visualize it. You can do the same thing for any geographically distributed query. I'm not going to go into this either. This is hard places from the New York Times index, and we could look at what kinds of queries are associated with hard places, what kind of queries are associated with easy places, and you can do all sorts of stuff. This is a nice little note from some researchers at the Board of Governors on predicting recessions at different forecast horizons. It uses a similar model to what we use, not the same thing, but similar, and finds out what predictors seem to be the most helpful in predicting recession onset at different horizons. So I'll leave that one for you to follow up, and that's the end. So thank you for your attention. It's been a pleasure speaking with you.
Great. Thank you very much, Hal, for your extremely interesting and insightful remarks. I'm sure you have provided our viewers and listeners with some thought-provoking takeaways. I myself have like a dozen questions I would like to ask, and I'm sure it's the same for Per, but in the interest of time, let us keep it to 2 or 3 questions each. My first question, Hal, touches upon collaboration between your team at Google and various central banks. And I would like to know, what do you see as the key value or contribution of this partnership to the economy or the financial system? And if there are any successes or achievements that you would like to highlight in this regard?
Well, one of the things you can do is you can go to Google Scholar and type in this nowcasting or BSTS or any of the terms that I use in the discussion, and you'll see dozens, if not hundreds, of papers that people have worked on at central banks and at other places. So, for example, one of the things that you can do with this system is it's very, very good at predicting vacation activity, particularly in Europe. So people in March and April are planning their vacations, and then they take the vacations in July and August. And vacations can be very, very important for some countries and some cities. For example, in Egypt, it's 12% of GDP. And this is something that the Bank of Spain has worked on, Bank of Israel has worked on. Several of the central banks in Europe have built models for vacation planning, vacation forecasting. And it's a case where it's not just nowcasting, it's true forecasting, because you're looking at these searches now, the intent that's going on now, and the outcome is going to be several months from now.
Great. Thank you very much, Hal. My second question is a bit more forward-looking. This conference is being attended by hundreds of central bankers from various jurisdictions, and I'm sure many of them would be very much interested in hearing your views on which areas of technological innovation you would suggest for the central banking community to pay special attention to in 2021.
Well, personally, I think it's very interesting to look at regional macroeconomics, that is getting data at a regional level and thinking of a place like Ohio as being a small country that trades with its neighbors and it has this kind of regional dynamics that we also see in larger country level analyses. So I think having fine-grained geographic data about economic activity is going to be very helpful in improving our understanding of macroeconomics.
Great. Thank you very much, Hal. In the interest of time, I will stop here. Per, I'm sure you also have a number of questions that you would like to discuss with Hal, so please, over to you.
Thank you very much, Adam, and Hal, good to see you again. And I have two questions for you, if I may. One is, as you may know, that in Europe we have now launched a new EU open data strategy for creating one market for sharing digital data. What is your view in this initiative, and what are the enablers as the next step for digital data to become a public good?
Very good question, and we've been working on related issues ourselves. About 4 or 5 months ago, we released something called Dataset Search, which allows you to go to Google, type in Dataset Search, you'll be taken to a search box where you can look for data on various topics. So I would strongly encourage you to use some of the metadata that comes out of the Dataset Search project, because it will make this data much, much easier to find. And I think it's an open standard. Everybody can use it. It's just a way of describing data sets in a way that they can be easily found. Also, just as a footnote on that, Natasha Noy, that's N-O-Y, is the researcher at Berkeley at Google that built this, and she has a very nice little paper full of descriptive statistics about how data is available on the internet. So that would be worth looking at as well.
Right. No, but I certainly can see this, Al, that the metadata describing the content is, of course, vital for enabling the sharing. My second question, Hal, is relating to private-public partnerships. So maybe our collaboration that we have between the ECB and Google may be a good example of this. But what are the enablers, according to your view, for increasing the data sharing between academia and the private and public authorities?
Yeah. So, as you know, the IMF and the World Bank just had their annual meeting maybe 10 days ago, something like that. I spoke at that meeting as well, and there's a great deal of interest in this question. I'll tell you our view at Google, or maybe my view at Google, is what we like to do is give the data to everybody or to nobody. Because those in-between cases, if you have to make a custom provision for one party or another party, then it gets to be quite consuming of resources. And it's much better to have a uniform policy that people could use to access this data. So anybody could use trends. Anybody can download the CSV file. Anybody can embed the maps and so on. But if you're a nonprofit, a government agency, research center, then you can also get access to the API, which allows for a more flexible way to query the database. And I think the best thing to do is to start small, try a few small projects, see how they work, gain some expertise and understanding, and then branch out from there. Because I'm sure these relationships will evolve over time as people learn the value of this kind of data.
Thank you, Hal.
So when related to that, Per and Hal, I thought we would also like to hear your thoughts on data sharing, but there have been concerns about consumer protection and all that. What's your thought on the right regulations on data sharing that would protect consumer privacy, but at the same time avoid discouraging fintech innovations?
Right. So in this case, we spent a lot of time, roughly 6 months of time, figuring out a framework for releasing this data in a way that protected privacy. So to show up in the database at all, you have to have something like 40 or 50 instances of the query from separate IP addresses. So you can look at situations where it's a relatively common query. Now this has pluses and minuses. It's a plus because it's almost impossible. I mean, it is impossible to access any kind of individual data because of that aggregation choice. But it's also problematic in the sense that for some kinds of research, it is important to be able to get down to fine granularity. Like, for example, epidemiologists. Epidemiologists want to look at the progression of disease, and that's become particularly important these days because of COVID-19. But what happens is they can't follow it down to its source because you're getting fewer and fewer people issuing queries as you go down. So we've kind of stuck with looking at things at the county level or sometimes at the metro level, where there's places where aggregation is your friend, and it's not possible really to reverse engineer any individual data.
Great. Thank you very much for your response and for participating. This is awesome.
Great. Well, I'm glad it worked out. I have to say I was a little skeptical, but it worked very smoothly. So maybe I'll give another talk next week.
Great. So many thanks again to Hal for his pre-recorded remarks. I'm sure he has provided a number of inspirational and thought-provoking points. I'm now looking at the watch, and I think we do have time for 2 or 3 questions before the session concludes. There is a delegate question which relates to the area of consumer protection that we have already briefly touched upon. And Arash would like to know what regulations we have or should have in place to make sure that the big tech firms do not misuse their access to the private big data.
Thank you very much for that question. I think this is vital. This is quite a fundamental question. And we have the General Data Protection Regulation in place. So, of course, when we're talking about borderless sharing or simply sharing of data, that has to be ensured that it follows the General Data Protection Regulation. In addition to this, of course, in particular, central banks and other public institutions are, of course, used to protecting confidentiality. So this is our bread and butter. So, of course, we have a lot of confidential data, and we have certain methods in order to protect, and there are also data protection confidentiality regulations in place. And of course, when we talk about sharing data, these has to be fulfilled. So this is not only related to consumers, but certainly also to corporates, or any way of one can identify individuals or individual firms has to be removed from the sample if they are too dominant or if it's feasible, also with combining other sources to identify the person. So this is absolutely fundamental, and it's a precondition. Now, having said this, there are various macro-aggregation methods that is available and can be used as part of aggregating the data to a very low level while still preserving the statistical properties of the data sets, that it can then be used, for instance, for research purposes. And then, of course, there's also various methods for anonymizing individual data. But of course, the General Data Protection Regulation shall not be in our way to have a borderless strategy for digital data, simply because the volume of information is so large that we will need to ensure that data is feasible for it to be shared among different countries. And there, of course, the European Commission has come out with a white paper having how to share data within the European Union, for instance, and there are certain conditions that has to be fulfilled also for sharing them outside of the European Union. So there is a good start of this, but I think the question is so relevant, and I think every time we speak about this, we should always say that it should never circumvent the General Data Protection Regulation and the protection of confidentiality of individuals before we start using the data or sharing it with anyone else. So thank you for that good question.
Great. Thank you very much for your response, and many thanks again to Arash for the excellent question. Another question I would like to ask Per relates to the disruptive era of the COVID crisis and the post-COVID world that we will all need to deal with. And maybe could you provide some examples of how the collaboration or partnership between the big techs and the central banks can provide added value or benefits to the economy and the financial system?
Okay, yes, thank you, Adam, and thank you for that very valid question. Of course, the COVID has simply been a trigger point to try to get more timely information of the impact, in particularly of consumer spending. So how can you track consumer spending? So for instance, I mean, we actually know in Europe people are saving. So you can see saving rates going up. So people are not really spending, they're saving as such. But if you would like to track it, of course, you could use credit card data and payment systems, mobile pay, supermarket scanning data, if you have a representative large market. You can also look at the lending and the financial platform and see who is borrowing and who is lending from these platforms. So the market is segmented also according to the digital platforms. The Amazons of these worlds, right? You can use this data to see which category of products are being sold and how much and what are the differences if you had access. Other examples is cargo transportation, right? So the postal services, parcels and boxes, how much are they moving around and how much is the value of these? So there are ample opportunities, only of course if the data is standardized and structured in a certain way that it can be read and produce time series. And of course, in addition, that we have to ensure that we have the protection of confidentiality, so no individual person can be identified or being identified by combining with other sources. Thank you, Adam.
Great. Thank you very much, Per, for his response as well. Your remarks brought us pretty much to the end of the session. So thank you very much again for your very interesting and insightful presentation and also for answering the questions from delegates and myself. It was great to have you here.
Thank you very much, and thank you for the invitation.
Also, I would like to say a big thank you to Varian for pre-recording the presentation and to his colleague Barbara Phillips for making all this possible. And last but by no means least, I would like to thank you, ladies and gentlemen, for your attention and for your questions and contributions. I hope you have enjoyed the session, and I would like to wish you a great rest of the conference and a very nice rest of your days. Thank you very much, all the best, and goodbye.